Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 316 for October 25th, 2021. We are recording this a day ahead of time, but this is going to be the Option Professor solo episode for the month. So he's going to be on in a second to give you his market overview for the month. My name is David Kosmeter. I'm the creator of TimingResearch.com, and like I said, you should be seeing the Option Professor screen right now, and he's going to give you his market overview. And I'm going to go ahead and turn it over to him.
Okay, thank you very much, David, and welcome everybody. We got a big week ahead of us. 30% of the S&P companies will be announcing earnings, so I expect nothing but activity here this week. Quick background on myself, Option Professor. I've been in the markets here for decades, conducted hundreds of seminars, both live and on the internet with webinars for thousands and thousands of investors over the years, educating them on the uses and risks of options. Also, obviously, I'm following all the markets for all this time, so I'm very familiar with all of them, and I'm going to share my opinions and my overview on things. Again, we always start out by saying that all investing does involve risk, and you should be consulting your brokerage firm and your broker to determine your own suitability and risk tolerance. And basically that past performance is not indicative of future results. And of course, all the information and opinions we're giving is just that, information. It's not advice. Okay, so having said that, let's get started and see what's going on, because there's a lot to cover. I'll be covering everything, believe me, everything. So get a pen and paper if you want to take notes. Okay, we're starting out with the S&P 500. Obviously, we had a big run up. People who listen to our letter that we send out are very well aware that we thought the 4,300 level would be very, this is a 20-year graph. I'm going to bring it into a 1 year so you can see better what we saw. We thought this 4,300 area would hold. Here's our 5-year average, and that's where we came up with the number. We didn't come out of our head, right? You see this 4,300 ballpark area? That's where the moving averages were. Once we closed back above the green, which is 43.67, it was game on. And basically we told people that. And of course, now you are up here a little bit testing the high. And the risk right now for us is this. The VIX went down to 15 and the market's on its all-time high. Last time we had this kind of setup was in August, and we'll show you here what we're talking about. August. Yes, that's July. This is August. Okay. So we came up here in August and then we were right there. And we went from about, it looks like 44.80, and we had a sharp drop down to the blue, down to the red line. And that's the 12 SMA for those of you wanting to know. So the last time we had this set up in August, we did get a sharp drop. I don't know if we're going to get that or not, because there's a lot of news coming out this week, and a lot of it may be positive. So it may not happen again. But the risk is that we do have a pullback towards the red line. And the red line now comes in at what price? It comes in at 44.58. So again, not a big drop, but a little bit of a correction or some news that hits the market would not surprise us. And then, of course, after it has that reaction down, we would anticipate that it could get back on the bicycle. But that's what the trend looks like right now to us on a little bit of a longer term basis. Okay. Now, what's going on to make things happen like they've been? Well, again, we're in our earnings seasons and they're knocking the ball out of the park. Something that we've told people about for the last year since we had the collapse in March. The operating leverage of these companies are off the charts. They didn't hire everybody back. They're not, their expenses have been slashed. They got lean and mean during the COVID. And so their operating leverage is tremendous. Now we've got a little match on the fire, a little gasoline on the fire. It's called pricing power. And go to the store, go buy a car, go buy anything, and you'll find out the prices are higher and people are paying them. The reason they're paying them is they have the money. And why do they have the money? Because their stock portfolio is way up. Their house has gone up 20%. Maybe they got a raise. They can't go anywhere like they used to spend the money. And so you add it all up and bam, you got household net worths doing fantastic. And these companies out there are playing the inventory game of there's not much here, so we're just going to raise the price. That has been very helpful to some of the stocks. Now, last week we had a bunch of stocks come up and some of them had nice pops. A little later here, I'm going to go over some stocks that are coming out this week with earnings, and that we think may have a pop as well. And we'll show you the chart. You make your own decision. But again, what we're looking at on a longer term basis is inflation. And of course, wage inflation is here to stay for the foreseeable future. Why is that? Because the JOLTS report is telling you that there's a ton of jobs out there. And we're finding out that the people don't want to go back to the low paying jobs. They don't want to go back to the service jobs. They're looking for other better jobs. And we have a quit to layoff ratio, meaning the amount of people quitting the job because they're either have enough money or they're confident they'll get a better one. That number is totally outdoing the layoffs. So watch the JOLTS report. That might be the big key looking forward rather than the jobs report. And again, expect wage inflation to be here for some time. As far as monetary inflation is concerned, in regards to energy and food, that is a little bit more of a wild card. Why is that? Because energy prices have gone way high here, and Biden is starting to squawk about it. And again, Saudi Arabia has the oil ready and able to bring on the market. And on November 4th, I believe there's a meeting. If they come into that meeting and they start supplying a bunch of oil at $85 a barrel, we're going to get a backing off of that price. And if we get a backing off of that price, that's going to affect the inflation feeling out there. Also, the bond market went up to that 170s area. If it can't get through 175, which is the first quarter high point, and it starts backing off like it did Friday, again, you could see an inflation back off, and then you could also see interest rates come back down, yields come back down. And that, of course, might be hurting some of the trades that are doing well, like the value trade, the dividend paying trade, which are doing better again and the cyclical trade, because the rates are going higher. If things look like they're cooling off, then obviously that might change that as well. Weather is going to be a big deal this winter. If we get a big cold snap, then these energy prices could pop. And then again, we're back on the bicycle. But if you've noticed, the natural gas prices have backed off. Okay. And now they're kind of waiting to see, how things are going to pan out at the OPEC meeting. And they're also waiting to see how winter unfolds. So we'll have to see how that works. Other things to talk about here is bottlenecks, right? Bottlenecks. I was out there at San Pedro about a month or so ago, and there is obviously a lot of containers right there in the harbor. It seems to me that the bottleneck situation may start getting resolved here pretty quickly, particularly before Christmas. And so that's why we have been favoring for the last 2 weeks, 3 weeks, the transports. So you go look at IYT and you tell me if that doesn't look good. And you tell me how CXS and UNP, the railroads, look. And so basically, again, we think the transports are going to obviously benefit if they unlock the bottlenecks. This stuff has to get delivered some way, right? And again, the trains are the ones that pack the stuff on and bring it all over the place too. So we think there's an opportunity there, and they're discounted from where they were. In other words, well, they were 2 weeks ago, 3 weeks ago when we were talking about them. But bottom line is they may have a future to them, because obviously these products have to get to where they're going. Other things that we're seeing here, pretty much that the US dollar could be also something to keep an eye on, because our trade deficit is going through the roof, and our fiscal deficit is going through the roof. And at some point, that may have an effect on the dollar. So we have to keep an eye on that, because the dollar index was way up at 104. We got bearish on it. It dropped down to 89. We got bullish on it. Now it's back to 94, 96 at one point. That's where we are now, negative on it. And now it's in the 93s. So if it can't get through 94, 96, we think we're looking at the top of the dollar. And we think very conceivably it rolls over next year. That's our position. Again, everything has a if and when, right? We think 94, 96 is the resistance. If it gets through there, you have to change your view. But right now, that's the view. Okay, so anyway, on a long-term basis, let's take a look at stocks. Because the whole world's talking 4,800 to 5,000 on the S&P. Could it happen? Of course. But let's talk, let's put a little balance into this stuff and see what could go wrong. Because again, when everyone's on one side of the boat, you got to look at the other side of the boat. we've got a situation here on the 20-year graph that you can see. These are the moving averages, right? 12, 24, and 36. That is very, very extended. Now, it could get more extended. And look at your RSI. RSI is down here. Okay. So realistically, RSI was, here at about 87 back in 2018, right? And now we're way up here and the RSI is at 72. This tells us that this is a very big divergence, or this RSI is going to play a mean game of catch up and get another 10 points on it or so. But anyway, by any measure, the market is very extended long term. Okay. And this is really all about valuations. Yeah, we are at what, 22, 23, 25, whatever on the P ratio. And obviously all of this stuff is more like 15, 18. You see all this stuff all these years? Okay, so that's 15, 18 PE ratio. This is where you get 23, 25. Our whole thing is this: if rates do rise at all, they're going to compress these PE ratios. And if they compress the PE ratios, it's even with better earnings, it's not going to be able to hold the levels because of strictly valuation. And people are going to be very, very surprised that the market in 2022 or 2023 is not doing as well if the rates are higher and the earnings comparisons are going to be a lot rougher, because we're hopefully, unless a variant comes out, we're not going to have those lockdown and then pent up demand numbers anymore. It's going to normalize out. And when they normalize out, again, it may be difficult to keep these very extended valuations going. So again, that's the future. Right now is right now. But, I wouldn't go to sleep at the wheel, because, if you start seeing cracks in the armor, there's a lot of real estate underneath these prices. Okay. So that's why we're very much of the school of ride the wave, enjoy the wave, but don't go to sleep at the wheel, because that's going to be very dangerous. And be very careful about adding a ton of money at extended prices, because if you get caught holding the bag, it's going to be a very expensive bag. Okay, so there's your S&P on a long-term basis. Here you are on a shorter term basis, 5-year. You can see we did have a correction. That was the buy zone, as we talked about. Now you should be just enjoying the ride. On the 1-year, again, you've got a situation here where we are up here and we got big earnings coming out. So popping to 46 or 4,800 is really what people are betting on. And again, according to the graph, it looks like that's the direction it wants to go. But this blue line is kind of flattening out, right? And the green and they're all not inverted to the upside. So again, could there be a pullback? It's possible. So be careful. If there's any disappointments this week, there will be a pullback. You've got all the tech stuff coming out. So again, these things, Google, Apple, Facebook, Amazon, these guys are probably going to announce great earnings. But if they don't, for whatever reason, then of course you're going to be looking at a big surprise. But again, that's not what people are betting on right now. Okay, so there's your S&P. Now let's go over to your, let's look at the 1 month, because the shorter term one sometimes gives you the hint of a turn. If we started breaking under 45.20, if we start breaking under 4,500, that is going to be something of concern. So you've got your short-term support right where we are now, 45.40, then your 45.20, and then your 4,500. Those are your 3 support zones you don't want to break. If they start breaking those, obviously something's changing. And maybe that 100-point drop I was talking about, which was similar to the August drop, might be happening. Okay, so looks good, but you always got to know where the lines in the sand are. And that's our lines in the sand right now. Okay, look at QQQ, because a lot of you guys are in the NASDAQ, and that did start to roll over because Apple did something where obviously it's been negative on it has been negative on the social media. Okay. And so let's take a look here and see what's going on here. First of all, on a 20-year graph, see, David Tepper was on and he was saying that he didn't really think anything was very cheap. Anything was a great price. And here's what he's talking about. Again, this is where these markets are. Okay, so obviously nothing is really on sale up here. You get it? You saw the S&P chart. Nothing is really on sale. So as he was saying, on a long-term basis, stocks may be part of a person's portfolio, and maybe the market will keep going because interest rates still cost of money to companies versus their net return on capital is still a very big wide window. These guys are bringing 10, 15, 20% return on equity, and they're only paying what, 2 or 3% for their money. That is a great ratio. And that's why you get these kind of numbers. And then of course, with interest rates being extremely low, ridiculously low, that also creates a high multiple. So the return on equity difference between that and the cost of capital, plus your low interest rate environment, put in valuations very high, that's the recipe. But again, this is not low prices. I mean, this is going back 20 years. So you see what it looks like, right? And Tom, Dick, and Harry are opening accounts, and the meme stocks are going, and now you got SPACs and everything else going, and of course the Bitcoin's going. So there's a lot of speculation going on under the surface, no doubt about that. Okay, so anyway, there's your NASDAQ. Let's go to the 5-year. Okay, had the pullback. Okay, so that's where you're buying on the pullback. And then again, this thing is just having a little bit of a pullback. So on this chart here, if you're in the QQQ, you definitely want it above 360. You definitely want it above 348. And if it can stay above 370, that would be good too. So again, you've got, and again, this could pop this week because again, it had a rollover. We'll get to the shorter term graph in a second. But this is one is chock full of all what the FANG stocks, which are announcing this week, right? So basically, the setup there is to pop through new highs if this thing can get going. And look, the RSI went down towards 50 here, and that was on in September. But even recently, but it's rising, and it's at 63. And sometimes when it's above 60, it's when you get an acceleration phase. In other words, when it's above 60, you get a big rally, a big run, a stampede type thing to the upside if it's above 60. If it's under 40, you get the stampede to the downside. So that's something on the RSI. All right, so let's take a look at the shorter one on the on here. Again, like I say, it had the big pullback here, and then it rallied. And then again, you got a flattening line there though. And so, like I say, it doesn't have the same look as this, does it? But it could be similar to here, where in May, we were flatlining and then it went on a big run. So again, maybe this is a flatlining thing and we're on our way to a big run. You got a good support right there at the 70 number. I think right around 70, 60, right around there. You certainly want it to stay above there. And on the 1 month, again, staying above the 370, 360, 370 area, very important. And you start getting above 376, you're obviously going to try to make a run into new highs. Okay, so NASDAQ doesn't look as bad as I thought it would, to be honest. Let's look at one stock that has been discounted because of news, and when they come out with their earnings, they could be surprising people because their average daily users have been growing. This one got hit because Snap got a bad deal. And so they hit the social media companies pretty good. So on a 1 month basis, it looks very lousy. On a 1 year basis, it looks lousy. Will it hold that 315? We're going to find out this week. On a 5 year basis, what does it look like? It looks like this could be a test, you see? This could just be a test because that's a rising blue line. A rising blue line, as you can see back here. If it gets violated, but then they get back above it, that's the buy zone. So how would I feel about Facebook? I would feel Facebook, if it can get above 327 and start holding there, 328, then I think you're in good shape. Gets back above 346. You're in better shape, and above 355, you're back on the upswing. So Facebook, very much important that it hangs around this blue line here and starts getting back above it. Where's your RSI? Yeah, you see your RSI is right there at 50 ballpark. little bit under 50. So you really want to get some strength out of Facebook. And if you do, I think you can follow it and use that 315 as a stop if it doesn't get taken out. So you got a nice line in the sand. You got a great company who makes a lot of money. Instagram, if they spin that off, I'm sure it's going to be very good for the shareholders. So, changing the name and spin off Instagram might be very, very powerful for this company. So again, you're getting it at a discount and you're getting something that has an awful lot of people using it still, no matter what anybody says. And the advertisers, again, they go after the eyeballs. So again, crunch time for this thing, you start seeing 300 on it, that's a totally different ball game. But again, there could be some support around 300 because these are former highs. But it's you don't get too many discounts on this guy. Let's look at Google because this one is probably going to announce very good earnings. And it's down. Again, similar to Facebook, you wanted holding this green line. It held the green line here. So 26.36 would be something you want to definitely now make it 2670 ballpark, 2670. You wanted holding that. And the RSI still above 50. But again, you want to see some strength out of these things. And you could, because like I say, you see the red line there is at 2810. We're at 2772. This thing breaks above 2810. You're back into probably taking a run at 3000 maybe. Okay, so that gives you a little bit of the NASDAQ and a little bit of the S&P. I'm going to throw a couple of other ones up there. Remember I mentioned to you the transports? Take a look at this thing. That thing looked like it's going. That's why we got positive, because it broke the blue line. And then once it gets back above the blue line, that's when we join the party. Okay. And as you can see, the party's running pretty good. And will it take out that high? If they undo the bottlenecks and we have a big Christmas deal coming up with the holidays, I mean, how do you think this stuff gets to port? I mean, it gets to these stores. Santa doesn't bring it, right? You got to have the railroads going. You got to have the trucking. And that's what's happening right now. So we saw this as an opportunity. And as you can see, we're all over it. Okay, let's look at that Russell. Same idea with the Russell, although I'll tell you something, it is crunch time. When all these averages get together like this, something big does happen. So, I'd keep an eye on the Russell here because this 230 number has been a real pain in the neck, hasn't it? Goes up there, pulls back, goes up there, but you got higher lows. Boom, 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 boom. Not bad. What's your RSI? RSI is above 50 and pointing up. So, this could be the week where it busts out. So you start seeing 230 or better. You got all your support right there at around 223. That's not very much difference, 227 to 223. So if we can get going, you got a good line in the sand, I think around 223. And let's see what the 1 year looks like. Yeah. And all this comes in around what? 222, 223, 224. So again, you get above this 230, this thing might be going someplace. The RSI is still above 50. So keep an eye on the Russell. I mean, if this thing is really a range and you measure the width of that range and put it to the top here, there could be a very significant move, either up or down. But again, the way the money flow is going, unless you start taking out 220 and 215 again and take this RSA back down, it does look like it's trying to build some steam. So those are two other indexes that people look at. And there's a lot of reopening stocks in the Russell and energy stocks in the Russell. So that's another way to go. Okay, let's look at a few sectors for you. And the sectors that everybody seems to love are the financials. And so let's take a look at those and give you some idea there. Again, higher interest rates are good for the financials. Why? Because then they can pay you nothing on your savings and actually make money on their loans. Basically, that's the story. And people have not been using their credit cards as much as they used to. If they start doing that, which is probably going to happen when things slow down, right? Because when things slow down, people are used to spending, and if things slow down, they need to spend money somewhere. So maybe they hit the credit cards then. But as you can see, let's give you the whole line of the sand here. This is on the financials, long-term, very extended. Breakout here again, came down and tested the blue line. That's when you want to be buying, when it's, when everybody's saying, oh, it's over. And if you got these moving averages working for you, you can trade it against them. And so obviously this is a place where you should be just enjoying the ride. Again, enjoying the ride. And on a 1 month basis, yep, you're trying to enjoy the ride. Now, could these things pull back? And listen, if that 10-year note goes from the 170 that it hit last week down to the 150 area, this thing will pull back. All right, next one is industrials. Again, the industrials are part of the reopening and reflation trades. So here you go. Looking pretty strong. Test the red line right there. Good buying opportunity right around 97, back up to 104. Again, you penetrate the blue line, but now you get back above it. That's when you get on the train. Okay, they got everybody out. They got everybody nervous, but the blue line kept rising. Now we're back above it. So you got a good deal here as long as you stay above about 100. And there you go here. There's all your stuff right there, right around 100, 102. So there you go. You're in there and you're looking for higher levels. RSI is not bad at 66. Let's take a look at materials. Again, just like the industrials, they were getting hit. Now they're back on the bicycle. 5-year graph will show that the trend has been rising, still rising. Same thing as industrials. They tried to nail it, got back above what price? 82.50. Boom, you're back in. Now it's at 84 and change. RSI is confirming that it's above 50. Not bad. Notice the RSI is above 50 the entire way up, right? And the blue line, so, that's why we like to use moving average. You buy it, you leave it alone, you put your stop underneath it, you ride it all the way up. You get stopped out here, gets back above it, come back in. Okay, next one is going to be, what do you got? Materials, you go energy. Oh, let's get energy. This is the XLE. This is all the big stuff. Chevron, Exxon. Looks like it's going somewhere. Again, could it pull back? It might, but the bottom line is the RSI is looking pretty good and all the lines are crossing and they all come in between 50 and 52. So you're up here at 58. And on a 1-year basis, it's going to be pretty extended. So again, but it is holding the red. So right now you want to keep it on a short leash. 57 is your number. Moderate leash, 54.60, and a long-term leash would be more around the 52 area. If you want to look at it on a long-term basis, though, there could be plenty of real estate left. Plenty of real estate left. And I don't know, are they going to form a head and shoulders? This is the shoulder. There's your head. If it's going to come up and do another shoulder, you're going to get up here towards 80, and then you maybe make the other shoulder off of that. Or at least up to 70, and then make a shoulder, head, shoulder, something like that. On a short-term basis, again, you want to stay above 57 if you're a short-term trader. You don't want to see underneath there. RSI is on the ledge, so, this thing starts breaking under 57, it might be telling you that energy prices are backing off. XOP, that means your oil exploration guys, your Halliburton, Schlumberger's, that kind of stuff. The exploration and producers. Looks like it's breaking out a little bit here on the 1 month. Keep it above 105. On the 1 year, kind of extended, and that red line's been kind of the line in the sand, again, coming in right around 105. So if we hold 105, you're in good shape. If it breaks, again, a further correction could be in order. 5-year, look at that real estate up here, though. That's why people are saying oil is way up, but these stocks have not caught up. Are they going to play that mean game of catch up? They're on the process of trying to. Okay, but it's going to be how long they can keep energy up. If it's going to be higher for longer, then these things are going to go. If in the OPEC meeting and then Saudi says, okay, here's some more oil, let's bring these prices back down 10 or 15%, then these things are going to have a correction. So that's why if you want to keep things on a short leash, you use the shorter term graph. If you're doing investing for the longer term, then you use the longer term graph. And in this case, you'd be looking for pullbacks to buy into. Again, has there been investment into getting more oil? No. Has fracking been going great? No. Is the rig count been lousy? Yes. But here's some changes. With the higher prices, fracking could come back on. It takes time. Investment could come back in. It takes time. And the rig count is rising. Okay. So things do change in the oil market. And I just gave you what's going on and what could go on that would change the landscape. But right now, obviously, money's been coming into it. You only have to say to yourself, is this a point where if on November 4th, we start getting some word out of OPEC, Saudi Arabia, that they're going to take all those barrels that are just sitting there and move some into the market because Biden makes a phone call? I don't know. But if that happens, obviously, we could get the bloom coming off the rose. So that's your energy market as well. And let me, one other one would be consumer discretionary. Hey, we're going into Christmas. Are people going to be buying up the storm, spending a lot of money during the holidays? You would imagine they would be. And that's why this thing's breaking out. So you've got, this is consumer discretionary, which is everywhere you wanted to spend money, but couldn't ask. And so basically that's breaking out to the upside. RSI is breaking out as well. That's on the 5-year graph. On a 20-year graph, it's extended like everything else, but it's into all-time new highs. Again, the consumers out there spending. Retail sales were supposed to be down 0.2%. It came in up 0.7%. China's economy is slowing. There is no doubt about that. Their housing prices have dropped for the first time in 6 years. They've got a tremendous amount of vacancies, kind of like what we had in 08, kind of, where there's these buildings built, or they're half built with weeds in them or whatever, or they're vacant. That's what they got going on over there. But their retail sales were up, which means people are spending money. So that's what consumer discretionary is all about. And then that's why that's a bicycle you want to stick with. You had a drop down here in March, great time to buy. You had a little bit more drop. You just recently had a little bit of a drop towards, towards the 150 area, down towards the 180 area. We're right back up again. On a short-term basis, if things did get a little bit dodgy, you don't want it breaking 192, 191, and 189. So if you want to keep things on a short leash, those are 3 numbers that you could keep an eye on and see if they can hold. Because this run started here, and again, it held the blue line all the way up. So that's another one for the reopening, is consumer discretionary. Okay. All right. So that gives you a little bit of an overview of the stock market. And now let's talk about the real, the straw that stirs the drink, which is interest rates. Okay. Now here's our view on that. Okay. Again, we said the 175 in March, okay, until it's taken out is the high point. Okay. Now, if they take it out, everyone's saying it's going to go to 2. It's going to go to 2.5. And our position is, we have no idea where it's going if it takes out March's high and the TLT, which we're going to show you right now, takes out the low. We have no idea where it's going. And you know why we have no idea? Because there is a debt bubble that we have never seen in the history of mankind. What does that mean? There is more debt from governments, municipalities, corporations, you name it, real estate mortgages. Never had it before this much. And we never had it this much at this low of an interest rate. So you want to talk about a double whammy? When interest rates go up, the value of all those loans go down, right? Of all those bonds go down. Now, with all those, and how much is in negative yielding? Still trillions. And how many are under 1% or 2%? A lot. So if A, the dollar started to lose some value, B, rates started to rise through 175, do you think there's a point where some of these people may want their money back because they're owning these bonds that are losing value? And what if they all want it back at the same time? That's what happens. And then you got the order imbalance. Now, do you know most bonds are done through a dealer environment, which means there's some guy who has to write a check and put his money in there, a dealer. Now, you know, from March of 2020, and you know from '08, and you know from 1987 and 2001, when people start dumping bonds, or 1998 with the long-term capital management. If you're older, you know all these things I'm talking about. If you're younger, go look them up. When these guys start seeing a avalanche of selling, do you think these people step in front of it and give you a good bid? No, they let the thing collapse, and then they wait for the buyer of last resort who prints money. That's called the Fed. Let them come in and buy this stuff. Now, I've been doing this for decades. Did I know that they could put 14 facilities together with the Treasury Department and start buying junk bonds or buying mortgages or buying corporate bonds? Did I think that was legal based on the 1913 Act of the Federal Reserve? I didn't know that. Apparently it is, because they did it. But again, you know, it started out with QE back in '08, where they figured out, hey, we can print money like Japan and Europe and buy our own securities with printed money that comes out of thin air. Well, if we start getting a run in the bond market, they're going to have to do the same thing. And they probably don't want to do that because they just did it a year ago with all those facilities. Now, unless they kept those facilities open and they could just do the game again, maybe they will do the game again, just print money, use those facilities and buy all the bonds to keep the bond market stable. That's possible. But in the interim, you're going to probably have some rocky road with that vanilla ice cream, right? So the bottom line here is you don't get anything more important than this bond market, because the cost of money is one of the main reasons this thing is up. The cost of money being so cheap is helping the corporations because their return on equity is way higher than that. And the valuations are allowed to go to these ridiculous levels. You know, 15 is normal. So if you're 50 or 50% above normal as far as valuations, because 23, right, is about 50% above 15, right? So what we're looking at here is a market that is at crunch time. You remember the blue line here? Boom, bada, boom, boom. You get underneath it, and then you get back above it, you're okay. Now you're coming back underneath it. So we need the 170 we saw last week to go bye-bye, and we need these yields to drop so that this chart on TLT can go back up. And if it can do that, then you've got game on. And look, you're right at the 50 number ballpark. So this is crunch time for the bond market. You start blowing out 135, okay? Then who's to say it stops here or here or here or here or here, right? You don't know that, right? You blow out that level and there's that much debt in the world and that many people who might want to redeem. That is not really what the Fed wants to see. And again, if you start getting now this is going back 20 years. So, you know, rates have been dropping overall for 20 years. Okay. Now this is ridiculous. That's a blow off top, but that doesn't mean you can't meander in this neighborhood for a long time. And that's why people say interest rates will be lower for longer. Well, they're saying it's going to probably hold 130, right? This 130 number, and it's probably going to not get much higher than 160. And there's your range for the next how many years? Just like it went from, 115 to 130 from 2016 all the way to 2019. There's 3 years of it in the range. Here you had another range here, you had another range here. So these things can go into ranges. But what I'm saying here is that if it starts breaking to new lows, the stock market is going to notice that. And if we're at 4,800 and this thing starts breaking under 130, that's not going to work. Okay. In other words, it won't last for long, I don't think. Okay. If that happens. So keep an eye on TLT because that's your cost of money right there. All right. I'm going to go and give you a little bit of idea on some of the stocks that are coming out this week on earnings and where we think there could be, if there's an earnings surprise, a pop in the price. So let's take a look here and I'll show you a couple of examples from last week. Crocs came out with their earnings, right? And those are the shoes that everybody seems to be buying. And again, we'll show you what we're talking about. Okay, so Crocs comes out and see the moving averages are all kind of looking good, right? And so Crocs is trading 136 right before their earnings report. So obviously they faded it for whatever reason down to the blue line. Then the earnings came out and you go from 136 to 154. That's a pretty good pop. Okay. Another one that popped last week was Seagate Technology. See, we're using the 1 month because we're trying to keep it on a shorter leash because this is for a short-term speculation. Okay, again, market got under the blue line, right? But got back above the blue line well before the announcement. The announcement comes in and you go from 81 to 89. Not a bad pop, right? All right, so let's take a look at a couple that we are smelling around, thinking it might happen again. Tuesday, we have got Principal Group coming out. No, that's not what it is. One moment, please. Principal Financial. And it's in a decent sector, right? Okay, so I don't know. Is this thing going to be able to pop or not? It's holding the blue line here. It's holding the blue line. It's right around here. Let's see what it looks like on a 5-year basis if there's anything above. Yeah, so like I say, could it pop up here if they get a good report? You know, give you a little bit of a pop. It's possible. And again, this is one that we're looking at that might pop a little bit because it's in a nice setup to do it because the averages are all pointing up and the RSI is above 50. And, like I say, this 70 has been some resistance. So it comes out with a good report. Maybe it could get some legs. So that's one right there. And they come out, I guess, on Tuesday. Next one is Evercore. They come out on Wednesday. Again, let's look at the 5-year, give us a bit of an idea of where it's been, where it's going. Yeah, it's already gone a little bit. Yeah, it's already popped. So it's popped a little bit of it in advance, boom, boom, boom. So it's giving you $20 already. This one might have a hard time popping unless they blow the cover off the ball. But it's already had a big run. But it's also into it's into rarefied air here. I mean, where's the resistance on this company? There's no technical resistance there. What about if you go to the 20-year? Yeah, this is an all-time high. So you don't know where this kind of thing could go. It's a speculation, no doubt about it. But again, it is coming out with earnings. It does have the setup of all the different moving averages pointing up. It has pulled back off of the 164 to 159. So if the earnings are good, maybe you get some action on that one. Next one is a copper mining company. They come out on Wednesday as well. And this thing's been a great stock. We've been talking to people about this thing since it was, I think, about 30. Yeah, I think about a year or two ago, it was just 30. Even like last year, I think it was at 30. There you go. Yeah. Yeah. Last year, 20 and 20, 30, 35. Yeah, this is where we were talking about it, right around here. And it's been a great run. Now it looks like it's rolled over a bit. RSI is right there. So it'll be very interesting to see how they come out with their earnings. Let's see what the 1 month looks like. We thought it looked pretty good. You see, it's above the blue line here, right? And if they get good earnings here, what's the RSI doing? It's right around 50. So again, if they get good earnings here, and what would make their earnings good is obviously the copper has been in high demand and the supplies are rough to come by. So they got a great thing. They got a product people need, and there's not a lot of it. So obviously the price of copper itself has risen well above $4. And so, we'll be interested to see if this thing gets a pop out of it. It's something that's setting up for it a little bit. So keep an eye on that one. So that's copper. Another one real quick would be an insurance company, the Hartford. They come out on Friday, I think. Yeah. And again, this one doesn't have the greatest look as the other ones going into it. So yeah, this one would not be one of the ones we'd like. I don't know why I put it up here. So strike the Hartford because it doesn't really have the same look that the other ones do. But again, that's something to look at, is find out who's reporting their earnings. Let's see if like a Google or Apple or Facebook looks like that. Okay, Alphabet, again, yeah, it looks pretty sloppy going into the report, but of course that means it could surprise people if it stays above 2740. Let's see if the 1 year looks any better. Yeah, well, like I say, this is the time where you got to get back above the numbers if you're not going to be a bad market. So where are the numbers coming in? All coming in right around that 2800 area. So, if these guys really knock the socks off of people, RSI is right to 46. So if this thing gets a good report and blows through 2800, then this thing is back on the bicycle. Looking at Apple. Okay, on a 1 month basis. Yeah, this thing could surprise people. The high's been 157. So, this thing is still, got all the moving averages pointing up on the monthly, on the yearly. Again, that blue line's not a good looking line right now. You want it to be pointing up like this. So if this thing starts breaking under 145, that might be telling you that there's more trouble in the heartland. Okay, so Apple's, these are not the best looking charts to set up. And Microsoft. No, not Macy's. Okay, there you go on Microsoft again. Yeah, the setup is here for a pop. Setup is there for a pop. You got the 304 there holding very good. You got the green line holding very good, coming in around 307, and it's holding the red line of 308. So if it gets good numbers, it could give you a pop. Okay. If they disappoint, though, you can see that a sell-off wouldn't shock anybody either. Okay, so that gives you a little bit of idea of some of the stuff going on. We are looking at a lot of the drug companies that have backed off a lot as well. This is really one of the Cadillacs of the whole drug area. Amgen. Okay, a lot of people are thinking that there could be some value down here. Let's just see. Here's your 1 year. Let's just see. Not looking very good there. Not looking very good there. Amgen gets back above 220 though. That would be interesting. Same thing with Biogen. These are discounted, so that's why I'm just pulling your coat to them, because not a lot of people like them now. Yeah, again, if you can get Biogen back above 280, that would be interesting too. So keep an eye on these things because they are discounted now. Okay, I want to get around the commodity corner real quick and give you a little rundown of what's going on there. Okay, let's talk with grains real quick. I don't have too much time left, so let's get to it. January beans, let's see what they look like. And I'll show you what I see. Okay. I'm going to get the Novembers up there, a little better chart. Okay. I'll show you what our feeling was on the beans. We thought when it broke above 9, that's when we were very, very keen on them. And can you see they ran way up to 17? Now they came back here to 12. And you see this number here? That was the last time we were very keen on beans. Okay. And then they came back here and now they're holding the 12. So this number here, which is the low, is very important as a line in the sand. And that comes in at about 1140. But really 12 is the number. You see this 12 number here? Okay. We really want to, and the low there, I think was 1180 something, 1184. Okay, 1184, very big number because it holds that 12 number. If it can do that, then this thing can get back on the bicycle. And how would it get back on the bicycle? Another problem with the weather in Brazil, another problem with the weather here, and we don't get the crop, and all these people want to eat. And the next thing you know, the prices get squeezed again. So is this the neighborhood where we're very interested in beans? Absolutely. We get any lower than that, we wouldn't be as interested. And the RSI is right at 50. So, we don't need this thing trading at 11 or 10 anymore. Okay. This 12 number is a reasonable number to use. If you want to use the green line, you're talking about 1140. But this neighborhood here is interesting to us because this is a big liquidation. And the RSI is back down a bullish area, but not overdone. Okay, so here's your soybeans. Let's turn to the next area, which is going to be in crude oil. And here's what crude oil looks like. Crude oil on a 20-year graph obviously looks very good. It's been holding that red line, so if you want to use that, but that's pretty overextended. Look at this here. Again, what's RSI doing? See, RSI is not really making a new high when this is making a new high, because that's a little bit of a divergence. So the setup there would be is that if on November 4th, OPEC comes in and says, we're going to give you some oil and bring these prices down, then this thing is going to have a sharp drop. But again, right now, the momentum is up. It's just a bit extended. Okay. Are we getting any warning signals that it could be turning? Right here, here's a nice little trend line to look at. Keeping this thing above 77, very important. 77 is not a bad support level. As you can see, it's been riding it up pretty much the whole way. Now, what about the 1 month? Anything on the 1 month telling us anything? Not really. Looks very strong. So again, 77 is a good line in the sand. And if you want to keep it on a very short leash, everything comes in here at about 82 bucks. So you don't want this thing under 82 bucks. It's at about 84 bucks. Okay. So there's your story on oil. Keep it above 82 bucks. You're okay. You start getting under 82. That's not good. You get under 77. That's really not good. Okay. But it does still look strong. Again, if they come out with more oil, this thing will probably get nailed. If it doesn't, and we have a cold winter, that's where you get the $100 crude from. Okay, let's look at the ones that we did say look like they're making a turn potentially. That is in the gold and the silver. All right. Now the gold's been going above 1800 and then failing. Look, went up there and failed. Okay, but it's holding the support line. This is on the monthly. So again, if you're trading against the monthly short term, you buy against the blue, you make out. It comes down, you buy against the blue, you're making out. Okay. What our problem is on the long-term graph, we need it to get above 1800 and stay there. Can you see it's all coming in right here? And the direction of the 1 year, the 12-month, the 12 SMA is still pointing lower. You see, it used to be up here. The 12 SMA was 1841. Then over here, as time goes by, it's 1815. And as it goes down, it's right now at 1798. So this thing is right there. Okay. And again, we are feeling that it could be a situation where it could take off by the end of the year. So if it starts getting above these areas here and sustaining, then there could be a stampede into gold by the end of the year, if it can do that. But right now, the jury is still out because you can see it's just tightened in that space. And the RSI is above 50. So that's what's telling us that we could be possibly on the verge of a very nice gold run. And of course, silver pretty much is the same game, but we'll show it to you there. So that's what it looks like on the longer term picture. You look at the 5-year picture. And again, see people, again, it's all coming together. It's all coming together between where and where. Let's see. 1775 and 1800. So this is in a tight range, and this tight range will resolve itself. Where's the RSI? RSI is pointing up and going through 50. So, that's not bad. So if you start getting a breakout here, it looks to me like something could be going on. The 1-year graph, again, it had some congestion to 1760. Now these averages are turning up. That's not a bad sign. They come in at 1774, 1765, 1774. And if you've noticed lately, that's been about the low. So this thing does have some legs, although the blue line certainly does not look like it does here, right? So that's what makes it a little nerve-wracking. And your RSI is above 50, but it does look like it's trying to take out. Next week is very important. This thing starts going 1800, 1820, 1840, 1850. I think it's on its way. And that's why, this stock here was very interesting to us. It pays 4%. You're getting paid 4% dividend. Now, dividends are not guaranteed. They could cut them, they could not pay them, but they're paying 4% for we know today. So you're getting 4% cash flow on your money, and you're getting this thing here at a discounted price from 74 to 54. So we very much told people this is a good deal. Why is it a good deal? Because again, you like to own gold? Good. You want to own it with somebody who creates it at about $1,000 an ounce? Good. And would you like to get about 4% on your money while you're sitting here watching the thing go back and forth for the next how many times? Well, then this is something to be, people always say you can't earn any interest on your gold, which is true, but you can get paid dividends on gold mining companies if you go with this company here. So we see this as a positive right now. Obviously, if it starts breaking under 53, we'll change our tune. Right now, our tune is up. Okay, what else is there? Silver is the same story. As far as gold, it really needs to get above 25 to get going. Some of the silver stocks that people like to look at, Pan America Silver, starting to take out. So that looks like it very good as long as it stays above that 23. And it certainly has plenty of real estate above. 20-year graph on it to give you an idea where it has been. Again, came back to the blue line, right? Now it's above the blue line. Where's the blue line? We'll tell you right now. Blue line is at 23.50. So like I told you, stay above those numbers and we're in good shape. RSI came down to 50 and is moving up. So this is the time to look at it. Not up here at 40 when every Tom, Dick, and Harry is telling you to get in, but down here. So those are two things there. And then a one-stop shop that we look at, and we've always told people, hey, listen, some of you guys, you don't want to trade the contracts, they're on margin. You don't want to trade the options because they lose money if they go to zero. Well, what about this kind of thing, which is a broad-based commodity fund, which is something we told you about the last 2 years ago, or at least a year ago. And as you can see, this is a fund. You need to go get the prospectus, and you need to understand what it's doing, and you need to be able to take risk. Okay, if that's all there, this is a one-stop shop because it is trying to mirror the commodity index, which is heavily weighted into oil, grain, and gold. Has some soft commodities as well. But here, when we were bringing it to everyone's attention when they crossed the blue lines here, $22. This is just something you sit on and you have an access or you have a exposure to commodities. So there you go. And that's no heavy lifting, right? So if you believe you want to get exposure to the commodity sector, this is one way of doing it on a one-stop shop. And certainly it has not been a bad place to be in the last year. Okay, we are wrapping it up now. It's coming to the top of the hour. Again, this is optionprofessor.com. You can go to the website, put in your email, optionprofessor.com, put in your email, and you can get our weekly update. And then we encourage you to email us with any questions you might have on anything, on any of the markets and on any strategies, anything else. And again, send your questions in to optionprofessor@gmail.com with your contact information. And we'll come back to you and try to give you our opinion. We do not give advice. So that is your call and your broker's call and your brokerage firm's call. Again, they're in a position to discuss with you suitability and risk tolerance. We are not. So again, shoot us the email, optionprofessor, optionprofessor @gmail.com. And again, tell your friends and associates to send their emails in or their questions in. We'd be more than happy to help anybody out there. Okay, whether it be an option question, a market question, or a strategy question. Again, if you'd like our opinion, please just send an email. We'd be happy to do it. All right, it's the top of the hour. I have to sign off. A big week ahead. Let's all have fun. Let's all try to be profitable if we can. And again, we'll be back with you soon. This is optionprofessor.com signing off. Thank you for being with us. And do share the email address optionprofessor@gmail.com to anyone who has any questions for us. Okay. Have a great week, guys. We'll talk to you then.